Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, we are looking at recession and recession-proof stocks. I'm going to go through 7 different stocks, but before we do that, we need to have an idea of what recession is, okay? So recession generally means, when the economy is doing really well, okay, when everybody will be out and about buying their products, whatever they like, okay, and then that means gross domestic product or GDP will grow. Okay, so that's basically how it works. So everyone is happy, everyone is getting raised, they're using that money to buy whatever they want to buy. Everybody seems happy about their economy, basically their money situation, and therefore they are happy to spend. That's perfect. There are situations where the economy is not doing well, where companies are not actually increasing their salaries, where companies are trying to cut costs and basically making people redundant and all of those things, and the economy is not doing well. And then if GDP drops for 2 to 3 months, okay, period in a row, okay, that's a sign of basically the economy is weakening. That means we're heading or we are in a recession. Basically, that's all it means. So when there's no recession, everybody's happy. We're buying products that we normally like to have. When recession happens, we don't like that, okay? And that means we're going to have to tighten our belts and make sure we don't buy products that are not basically necessity. And right now, it looks like, if you read the news, everywhere we look, there's basically news that says that recession is coming, there's a recession coming, okay, and then there's a recession coming, or is recession coming, whatever, okay. And when you see that, it's kind of a little bit disheartening, and you then start thinking about, okay, I'm not going to buy this, I'm not going to buy that, I'm not going to invest my money, I'm going to keep my money. And some of the ideas, okay, some of the things that you should be doing during recession time is this, okay. Pay off your debt, first of all, and build up a cash. That's really important, that you don't have any debt. Because remember, if your salary is not increasing, whatever, and you've got a lot of debt, then you're going to have a lot of stress. So pay off your debt first of all, build up some cash that you could potentially invest in great companies, okay? And keep investing for the long term. And that is really important. The reason I say that is because when recession hits, the sentiments change. Okay, we're not going to have what we had in 2020 and 2021, where everybody was buying these hyped up companies. People will stop buying stocks. And when that happens, it's a good opportunity for people like me and you to actually put some money to work, okay? But you have to make sure that you are paying off your debt, keep some cash around, and if you get great companies, quality companies in your portfolio that can definitely be around after the recession has happened and can then give you that 20-30% upside, then that's what you really need, okay? And the companies, or basically the sectors that do well, so if we look at the technology, for example, like companies like Microsoft and so on, they do well during recessions. But the reason for that is because the earnings might drop a little bit, okay? But remember, we need computers, also companies will obviously still be buying their products. And Microsoft have some sort of stickability when it comes to their products. So for example, if you are on their platforms like the servers, if you are using their cloud and whatever, you still will be using that, okay? And companies will pay for that regardless whether we're in recession or not. So I believe Microsoft is a great example of a company that can be, that can be bought during recession time or can be withheld on during recession time. But companies like, for example, Apple, on the other hand, becomes almost a consumer discretionary for me, because not everybody needs a new iPhone, okay? And you're not going to put a lot of money into basically $1,000+ buying a brand new phone when you are not making enough money, or when you haven't had an increase for a while, whatever, okay? You're going to focus on your essentials, like the consumer staples, that companies that sell products that are necessity to you and your family. You're going to focus more on healthcare, okay? Because healthcare companies are, healthcare is important to us. You need those medications, you need them, regardless of whether whatever. Okay, utilities, another great thing. Okay, we need those. We need to keep our houses warm. Okay, you need those energy companies. You don't need those communication companies. Okay, you're not gonna go to AT&T and whatever and Verizon, or just get a new phone or whatever. You're not gonna do that. You're not gonna get a new line. Okay, you're gonna probably want to have pay-as-you-go kind of mobile phones. Okay, and the materials companies do well. So you have to look at the sectors that do really well and pick those stocks that you think will be around for that long. Okay, right. Now we're going to look at 7 different companies that you could potentially add to your portfolio if you haven't got them already, and if you have it, maybe dollar cost average into them. Like I've always said, I'm not a financial advisor, but it's important that I share my journey and what I'm doing, and this is what I'm doing, and I'm going to share that with you. If you like this kind of content, please like the video. Okay, it's really important that just give it a like. It takes a lot of time and effort to put these videos together. I've always said to you guys, I'm gonna share my journey, and that's what I'm doing. Obviously I have a full-time job, I have a family. It's all really difficult, not difficult, but it's challenging to find time to sit down and do this research and put these videos together. So I would really appreciate it if you can just like the videos, subscribe to the channel if you haven't already, and let me know if you have any questions. So let's have a look at the first company. Okay, I'm building this stock screener thing from scratch, and it has a lot of formulas and things going on right now. I'm not going to share it because it's just very complicated. There's so much going on. I'm still building it. Sometimes it works, sometimes it doesn't. So what I'm doing is just to give you a quick example of what is going on. If I put Home Depot, for example, or instead of doing the research, copy and paste and then sharing it with you right now, by just adding the ticker there, it should automatically update all that information. Okay, and some of this information is extracting from different websites, and some of it is embedded in this spreadsheet that I've created. It took me a lot of time, but alhamdulillah, I'm getting there at the end. Okay, so first company we are looking at is J&J. As you know, J&J is in the healthcare. Like I've already said, healthcare is very important during these kind of times. Okay, J&J stands out as one of the top options in the sector for me, and it's because it's blue chip company. It pays dividend, it's dividend aristocrat, dividend king. Basically, in terms of performance, it's done really well this year. Okay, they are in the pharmaceutical companies. They have medical devices. They have consumer health care products, which they will be spinning off in I think July, August of this year, I think. Okay, so they're splitting the consumer side of things into a brand new company and so on. So I think this is one of the great companies that you could potentially own. I own it. It's my biggest holdings in my portfolio. They're currently trading $177 per share, $466 billion market cap. PE is about 23, price to free cash flow 57, price to sales 4.87, EPS. And so basically EPS this year is $7.42. Next year it's growing. And this is what you want to see. So these companies that are growing their earnings are the ones that will be absolutely fine, okay, because they have a products that everyone needs more or less. Current ratio above 1 and beta below 1, which is very good for us. 52 weeks highs will be like 5% off that. 52 weeks low, about 13% off that, and 1 year return about almost 7%, 5 year return, and this is price, by the way. We're talking about just the price of the company. Okay, so last 5 years this has actually grown about almost to 36%. In terms of business metrics, we're looking at return on assets of about 11%, return on equity 27.5%, return on investment about 20%, gross margin of 68%, profit margin of 50, almost 7, and then EPS past 5 years, okay, they grew that about 5 almost 6%. Shares outstanding, really important. You don't want companies that are diluting their shares. So right now they have $2.63 billion outstanding out there. Okay, you want this to decrease. You want the company to buy back, but during situations like this, you don't want the company to buy back those shares. Okay, and you want the company to have that cash around just in case. Sometimes it's good to buy back. I don't like when companies buy back their shares when the stock's too overvalued. Okay, if the stock is undervalued, then by any means go for it. During recession time, you want the company to have as much cash as possible, so it's very important that they keep that. But this should be going down, not going up, and if it goes up, then you've got a problem. Performance year to date is about 3.5%. Now, the S&P 500, right, is actually down 13-14%. But when it comes to J&J, they're actually up. So that is a very good sign. Dividend yield. Okay, so with dividends, you get about $4.52 for every share that you own. 2.55% of dividend yield. Payout ratio about 57%. Ex-dividend was up 23rd of May, so I should be getting paid this month. 5-year growth rate of 6%, which is decent. Dividend safety 99%. That's the highest you can get. Free cash flow. This is where I want to see. I want to see the company either using this money to buy back their own shares or pay me dividend or reinvest in the company, do something with that cash. But right now, if there is a recession coming up, you want the company to be cash rich, basically. Okay, next 5 years, the company is basically expected to grow about 5%, and it has economic mode, wide economic mode. Now you can see the graph by just looking at this. You will be straight away, you'll see the company looks like it's overvalued right now, because the price has been going up. Even though we had a couple of drops here and there, it looks like it's actually gone up quite a bit. And as you can see, according to Morningstar, okay, it's actually 6% premium, $167 per share. Simply Wall Street, in fact, that's not true. It should be 267. Let me just change that. Yeah, there was something wrong with the formula. So it's $266 per share. And if you go to here, you could see 265.93. So it's just rounded up to the nearest. Right, so 266. So as you can see, they think it should be about $33% undervalued at the moment. That's what they think. According to Tip Ranks, it's about 10% upside. It has a 10% upside. $196 per share. According to Yahoo Finance, okay, their price target for by the end of the year, these two are by the end of the year, okay, and these two are the intrinsic value of the business, $190 per share. So more or less the same, these two companies. Okay, so that's J&J. Okay, so that's the first company we wanted to look at. The next company we're going to look at is a little bit debatable, okay, because they are in the consumer discretionary, but Nike, I believe, is one of those companies where people, regardless of what is going on in the economy, they still buy their trainers. Okay, you see whether it's the economic downturn or not, they will actually buy those products that this company makes. Especially for, I have children, and every day we go like, oh, their feet is growing, let's go back to the shop center, and then you look around, and then is either Adidas or Nike. Okay, and that's basically what you end up by. Obviously there are other companies out there, but the main ones, the quality ones apparently, are these. Okay, again, to be honest with you, because in the consumer discretionary, I am not too sure, but I think in the long run, this company, you will not see this company, okay, doing really badly during an economic downturn. That's my belief. Currently trading $123 per share, market cap of $201 billion, P is 32, so it's a little bit high. Price to free cash flow is very high. Price to sales, very low, it's fine. EPS is decent, and then it's growing next year as well. Current ratio about 3, so they've got plenty of cash in there, plenty of money to actually cover current assets, to cover the current liabilities, and beta is just below 1. Okay, when you look at the 52-week high, it was basically off 31% of the highs, okay, and 19% of the lows. 1 year return about 8%, 5 year returns of $132%. Okay, now when we look at the business metric, you can see about 16% return on assets, return on equity 43%, return on basic investment almost 27%, gross margin 46%, profit margin almost to 30%. EPS past 5 years, we're looking about 11%. Shares outstanding 1.58 billion. Okay, and performance year to date is actually down 26%, which is nice. If you don't invest in Nike, it's probably a good time to look at it again. But the PEs are very high. Okay, and as you can see in the graph here, okay, look at that. It's just gone down quite a bit. I feel bad for those who bought around that time, but if you have it in your portfolio, just keep it in there. Don't worry too much about it. Okay, if you love the company, I'm definitely sure this is one of those quality businesses that will bounce back sooner or later. They do pay dividend, okay, and just below 1% on $1.22. Payout ratio about 30%, and the next dividend was the 3rd of June. In fact, that's today. Okay, so that means basically ex-dividend. It means if you buy it today, you get the dividends. If you buy it tomorrow, hey, you're not going to get that money for this quarter anyway. 5 year growth rate 12%, dividend safety 99%, free cash flow of $5 billion. Next 5 years, the analysts are expecting this business to grow about 21%, and they have economic mode, okay, wide economic mode. According to Morningstar, it's 11% discounted at the moment. The price should be 134. According to Simply Wall Street, actually very similar, 11%, and then 134. Tip Ranks is basically saying 159, so it's slightly higher. And according to Yahoo Finance, is 162. So these two kind of agree with each other. These two will agree each other. Okay, that is that company. Okay, that's Nike. there for you, or Nike, whatever you want to call it. Next company we're looking at is ABT, and that is Abbott Laboratories. This is one of those companies in the healthcare. Again, they sell products that everyday people, not every day, but the products that we need, or basically that you would use in the hospitals and so on, and that is in demand. That's not going to run away during recession time. The stock is currently trading $117 per share, $205 billion market cap. PE is slightly high, about 20%. Price to free cash flow is very high. Price to sales, not bad. EPS, $4.33. EPS next year, okay, doesn't look is growing much. If I'm honest with you. Current ratio about 1.90. Beta just below 1, which is what we need. It's down quite a bit. It's down about 17% from its heights, okay? And when you look at the last 5 years, they've grown this bit. Basically, the price appreciation was about $152 per share. Now, return on assets is about 10%, return on equity 22%, return on investment about 13.5%, gross margin 57%, profit margin 42%, EPS in the last 5 years 40. Wow. 40%, above 40% in the last 5 years, EPS growth. That's really good. Shares outstanding 1.76 billion, and year to date it's down about 17%. Now, in terms of dividends, they pay small dividend, $1.88 per share. Dividend yield of 1.60. Payout ratio is quite low, which is nice. Ex-dividend was 13th of April. 5-year growth rate of 12%. Dividend say that's really good. 12%, that's really nice. Anything above the 10, I like it. It's really good. Dividend safety, 71%. That's definitely safe. And then when you look at the price to free cash flow here, or free cash flow here, sorry, $8 billion. Next 5 years is going to 11.5. You might as well go like 12% growth. Economic mode is narrow. Currently, according to Morningstar, is fairly valued, $104 per share. Okay, what is the price right now? 117. Okay, so fair valued at the moment. 9% undervalued according to Simply Wall Street. 130, that's what they expect. 139, 140. They are very, very similar. Okay, these two are again very similar. These two are again more or less. Actually, in fact, those three are more or less similar. Right, so that is the next company we're looking at. Right, next company we're looking at is WM, and that is that company is Waste Management. Remember, I used to own this company in my portfolio. They collect rubbish. Okay, that's all they do. I think I'm not from the US, so I think that's what they do. Provides waste management environmental services to residentials, commercials, industrials, and all sorts of things. Okay, it offers basically collection services, including picking up and transporting waste and recyclable material from where it was generated to a transfer station, and that's what they do. This company is currently trading $159 per share. I wish this company comes down to maybe 120, because I will definitely love to add it back to my portfolio. Current ratio, when we look at the market cap, $66 billion, PE 35, price to free cash flow of 45, price to sales 3.51, EPS of 4.53. Next year, $6.20. So this massive growth, that's really, really good. Current ratio below 1, so that means they have more current liabilities than current assets, which is a little bit worrying, but 0.8 is not that bad. Beta, again, very low, so that's okay. Now, down about 6%, okay, from its highs. If you own this company in the last 5 years, you're basically right now sitting there with 115% gain in terms of price wise, basically based on a company that actually collects garbage. That's not really bad. Return on assets 6.60, return on equity 26%, return on investment 10%, gross margin 46%, profit margin 52%, EPS in the last 5 years 10%, which is really nice. Okay, and then that's the shares outstanding. It's down about 5%, 4.51% for the year. Dividend, really nice, small dividend. Okay, $2.60. Dividend yield of 1.63, payout ratio 52. Ex dividends was actually yesterday. 5-year growth rate 7%, dividend safety 74%, which is decent. Free cash flow 2.4 billion, so that's enough to cover the dividends and do all sorts of things with it. Next 5 years they're expecting to grow about 12%. That's really good for this company. I've always said this company is more of a growth company for me. Maybe in the next few years, and maybe in the next 5 to 6 years it might slow down, but for now it's really good buy. And economic moat is wide, and the prices we're looking at 26 premium, okay, almost 10% undervalued, another 10% upside, and then according to Morningstar, Yahoo Finance, $175 per share. So 174, 175, 175, 124. So you can see Morningstar is just kind of bearish. The other three are kind of more bullish on this company. I will be on the caution side and just be with Morningstar because I think 120, 125 it will be really a good buy for me. Right, the next company we're looking at is PG. This is one of the companies I own in my portfolio. You're not Procter & Gamble. I don't have to tell you. Okay, this is definitely one of the companies that will be fine with during recession time. Currently trading $147 per share, $353 billion company. PE 25. Price to free cash flow 29, price to sales 4.37, EPS 5.72. EPS next year is growing, is heading in the right directions, which is really good. Current ratio, again, they have a more current liabilities than current assets, and beta is very, very low, and off the highs is about 10%, 11%. And then when you look at the last 5 years, you're looking at about 67%, almost to 66%, 65%, okay, growth. Return on equity, almost 12%. Return on equity, 32%. Return on assets, 18.3%. Gross margin of 48%. Profit margin of 58%. EPS last 5 years, we're looking at about almost 10%. Shares outstanding 2.40, and is down 10% for the year, which is good because I wanted it to come back down to earth, because as you can see it's been going up and up and up. Okay, now so dividends is really good, 3.65 and almost a 2.5% of dividend yield. Payout ratio really good. Dividend was the 21st of April. 5-year growth rate of 4%. Dividend safety 100%. No issues there, 99%. $14 billion in the bank. Next 5 years, about 6% growth. They definitely have a massive economic moat. And then when you look at the prices, you can see it's overvalued again according to Morningstar, undervalued according to Simply Wall Street, TipRank, and Yahoo Finance, more or less the same. Okay, again, another great company. I would love this company to come back down to earth. Maybe 120s again. I'm definitely adding to my portfolio. I'm adding to my shares because I already have, I think, about 16 shares so far. The next company we're looking at is 3M. 3M, I'm sure you know about this company. This company do not just sell one or two products, okay? And this is one of the reasons of including them in this list, okay? They have safety, the industrial, transportation, basically electronics, healthcare, consumer, you name it, they have it all. And for that reason, I definitely think they are one of the recession-proof companies, okay? $148 billion, $148 per share, $84 billion market cap. PE is very low. Price to free cash flow is a little bit high. I need to check this, by the way. I need to double check the website that where I'm getting this information from. I don't trust their price to free cash flow. I might do the formula myself and just put it here. Okay, that's probably what I'm going to do next. And price to sales is very low. EPS is actually nice. Okay, and then you can see it's actually growing in the right direction. They have enough to cover their debt in the next 12 months, and beta is quite low. Is basically 28% off its highs. Okay, and then when you look at the last 5 years, that is madness. It's actually down 28%. That is crazy. Can you imagine owning this company in the last basically 5 years and you are down 28%? The dividend is really good. I think this is something to take away from this company. Okay, return on asset 11%, return on equity 38%, return on investment 18%, gross margin 46, profit margin 61, EPS in the last 5 years we're looking at about 4.4. Shares outstanding. Okay, again, you need to make sure this is actually stays the same or goes down. It's down about 16% for this year. And when it comes to the dividend, this is the reasons why a lot of people own this company, because they are steady Eddie kind of company. There's not much of a growth, but at the same time that you get nice dividend. Okay, almost basically $6 per share, dividend yield of over 4%, payout ratio 61. When you look at the last 5 years, they grew about 6%, 75% dividend safety, cash $5 billion in the bank. Next 5 years, they expect it to grow about almost 7%, which is really, really good. Okay, hopefully the price will recover after that. They have economic moat wide. Price, we're looking at base 20% discounted at the moment, 46% discount, 4% upside. Everywhere you look, basically, everyone is saying this company is undervalued at the moment. And I think this has a lot to do with it. The fact that it's growing about 7%, okay? That's basically it. So price appreciation, you're not going to get probably a lot with this company, but you will get a nice dividend yield every single year. The final company we're looking at, a tractor supply company. This company basically provides a lot of hardware, track, towing, tool products, all sorts of things for the farmers on agriculture side of things. It's currently trading $195 per share. Market cap just about $20 billion. P is above 22. Price to free cash flow is really high, because you'll see that in a second. And the reason I included this because remember, the farmers are not going to stop farming because there's a recession, okay? And the products the company provides, actually these farmers need. So that's one of the reasons. Price to sales is 1.63, so it's very low. EPS is heading the right directions. Current ratio is good. Beta slightly above 1, okay? It's actually down about 19% from its all-time highs. And if you own the company in the last 5 years, you would have made 250%, okay, on your price, basically, if you bought this stock, basically. Return on assets is about 13%, return on equity 51, return on investment 33, gross margin of 35, profit margin of 28, EPS in the last 5 years 21.40, shares outstanding, you've got their performance year to date about 18% down. Now dividends, they pay about $3.68 per share, dividend yield 1.88, payout ratio really low, okay, and the 5-year growth rate is about 18%, really nice. Dividend safety 68%. We're looking for something about above 61, okay. When you look at free cash flow, this is probably why this is what it is, okay. Price to free cash flow there, okay. So in the millions, it would have been nice if it was in the billions, but hey, that's what they have. It covers the dividend, but you probably wouldn't be able to do anything else with it. But the next 5 years, they're expecting the company to grow about 14.40%, economic moat wide. And when you look at their prices, you can see about Morningstar actually is saying is overvalued at the moment. According to Simply Wall Street, is undervalued. According to Tip Ranks, is actually it's got about 24%, 25% upside. And when it comes to Yahoo Finance, it's also more or less the same. Right, so that's the final company we're looking at. And like I said at the beginning, the reason we're looking at these companies is because you don't want to stop investing. You shouldn't stop investing because of there's a recession. You should actually start investing more if you have the cash lying around because it's the recession time. Because remember, when these companies bounce back, if a recession happens, we're not in recession yet, but if it happens, okay, that's what I will be doing. That's what I will be doing. I'll be looking at companies that have these sort of qualities, really quality companies that can be around for a very, very long time. I wasn't planning to make this video that long, but obviously it is that long. I'm going to try to cut the videos, the length of some of these videos, but I will put the chapters, so hopefully you can skip through if there's some companies that you're not really interested in, whatever. If you like this type of video and this type of analysis, I appreciate if you can just give a like the video. Have a wonderful day. Assalamu Alaikum.